What if everything you thought you knew about getting rich was completely wrong? We are taught that accumulating money is a math problem, that memorizing the right formulas or securing the right degree leads to wealth. But financial success is a soft skill. It depends on your psychology and how you behave. The biggest hurdle most of us face is a psychological trap called never enough. Modern capitalism excels at generating massive amounts of wealth while simultaneously fueling intense envy. Think about the last time you saw someone driving a sleek red Ferrari. You looked at the car and imagined yourself in the driver's seat, assuming everyone else would look at you and find you impressive. This is the man in the car paradox. That desire for validation creates an endless cycle of comparison. A specialized doctor making $500,000 a year feels rich until they buy a house next to a CEO making $10 million. And that CEO feels successful until they socialize with cultural icons like Michael Jordan, who has a net worth in the billions. The latter never ends. Even a billionaire sports legend is dwarfed by the absolute top tier of the financial hierarchy. People like Jeff Bezos, who can increase their net worth by $75 billion in a single year. There is always a bigger fish. Treating wealth as a scorecard to prove your worth to society generates a state of permanent envy. That emotional state drives highly intelligent people to make disastrous financial decisions. The lives of two drastically different men demonstrate how little raw intelligence matters compared to behavior. Ronald Read lived a quiet life. He pumped gas at a service station for decades and later worked as a part-time janitor. Yet when he passed away in 2014, he left behind an estate worth $8 million, accumulated simply by saving and avoiding the lottery or inheritance. Contrast him with Richard Viscone. Viscone held a Harvard degree and rose to become a successful executive at a major financial firm. Yet he went completely bankrupt during the 2008 financial crisis, losing everything, including his massive 11-bathroom mansion. Or consider Rajat Gupta, a former CEO of McKinsey. He was already worth $100 million, but his desire to reach billionaire status drove him to commit insider trading. He lost his reputation and went to prison for risking what he had for something he didn't even need. The gap between Read and Viscone defines invisible wealth. This wealth consists of the financial assets you leave untouched, quietly sitting in accounts to buy options and flexibility over your time, rather than luxury goods for public display. Securing your financial future relies on outsmarting your own ego to avoid self-destruction, rather than outsmarting Wall Street analysts. This equation illustrates the behavioral formula for true wealth. Your savings rate equals your income minus your ego. When you stop letting the desire to impress others dictate your spending, you free up the capital required to build assets. Once you start saving and investing that money, you face another psychological hurdle. High returns in the stock market come with a mandatory price tag: severe market volatility. When your portfolio drops by 20 or 30% in a single week, it feels like a fine for a mistake. But volatility is actually a fee. It is the emotional cost of admission for long-term growth. Stomaching that fee allows compounding to take over, where your earnings generate their own earnings. The math dictates that the vast majority of financial growth happens at the very end of your timeline, not the beginning. Warren Buffett proves the power of this timeline. Although he is one of the world's greatest investors, 95% of his multi-billion-dollar fortune was accumulated after his 65th birthday. He simply stayed in the market and let the math run its course. Legendary investors thrive by surviving market panics. They stay in the game long enough for the math to work, avoiding the urge to sell in fear, even when picking the perfect stocks feels impossible. Mastering your money means willingly paying the emotional fee of watching your net worth fluctuate, allowing time to work in your favor. Reaching financial peace requires you to actively protect your mindset and ignore the constant noise telling you to panic. We all face a psychological hurdle called the seduction of pessimism. If someone predicts a market crash, we lean in and listen closely. Yet, if someone suggests things will gradually get better, we often write them off as naive. This bias is hardwired into our biology, our brains to treat threats as urgent to keep us alive. Organisms that prioritized potential dangers survived to pass on their genes, making us deeply programmed to prioritize bad news over opportunities.
Timelines reinforce this bias. On the left, setbacks happen rapidly, wiping out fortunes overnight. On the right, progress compounds quietly over decades. But zoom out, and the perspective shifts. The slow curve of long-term progress eventually dwarfs those sudden panics. Financial freedom remains accessible to anyone with the discipline to stay the course. It grows from patience and emotional control, bypassing the need for a genius IQ or an enormous salary. Stop trying to look rich to people you don't even know. Master your ego, accept that market volatility is simply the cost of admission, and start quietly building the invisible wealth that buys your freedom.